Good afternoon, ladies and gentlemen. My name is Jeff Halley, a senior market analyst here at OANDA Singapore, and this is the weekly precious metals and commodities analysis. Well, with Thanksgiving upon us and most Americans, I guess, indulging in the turkey cranberry sauce arbitrage, we are expecting the second half of the week to be pretty quiet on the markets. What we have seen generally actually across the G10 space and commodities is fairly aimless trading, with the market tending to chase its tail on any little snippets of news, and that certainly has been the case also in the commodities and precious metals space. If we just crack straight into it now, looking at gold, let's just blow this chart up a little bit. We can see as the dollar fell the day before last, that gold rallied. This sort of confirms what I've said before, that gold is trading almost 100% inversely with the US dollar and US yields at the moment. So almost a gold position is in fact a US dollar position or a dollar index position. Dollar strengthened overnight, and we saw gold give up all those gains from this mighty rally the day before, all the way down to a low of around 1274. Having said that, we didn't manage to hold above this resistance at 1291.60, but we have now formed a new resistance at 1297.50 ahead of this 1306. And frankly, if we get above this level now, there's no reason why we can't challenge this 1300 level. The 100-day moving average, this red line, does seem to be a bit of a pivot point where we get an extension depending on which side of the line the close of the day is. We do have some pretty good support on the downside, though. We can see, despite all the noise, that gold is slowly but surely grinding higher. We do have this trend line support that goes all the way back to mid-October, and that's currently sitting at around the 1270 level, so that would be first support. Then we have the 200-day moving average, the blue line at 1265, and then the 1260 level, which is the key level for gold. And I do believe still that a daily close below that could see some structural long-term bullish positioning come to the market, wave the white flag, and exit. So this is the crucial level, this 1260, but we do have quite a bit of support on the downside. So it may well be that gold, despite the noise, continues its slowly but sure grind higher. Let's go to silver. Whoops, messed that one up. And it's been much the same story here. The pattern isn't looking quite as constructive. We can see this long-term trend line that goes all the way back to early July. It's held silver beautifully. We closed right on this trend line overnight at around 16.90. And because it's been quite quiet in Asia, it's just been doing some sideways trading. We are holding above this red line, the 100-day moving average, at 16.93, and that's about where that trend line is today. So I'm not going to call this a break just yet, but it does bear watching. If we have a couple of daily closes below this trend line now, that would bode ill in the short term for silver, and maybe would imply that we're going to see a test of this first support line around the 16.5380 level, where these series of lows are from the beginning of October. And then, of course, the 16.3270 level, this low in early October. A breakthrough there would almost certainly imply that silver is going to have a bit of a deeper correction. On the top side, although we did test 17.2950, we closed on it, but we didn't manage to hold above it. So that line, I feel, is still valid. We do have a series of highs that failed ahead of it, double top here, and a close on it here. And then above there, we have the 17.48 level, this October high. Beyond here, this almost certainly opens up a retest of the 18.0 level, and then around the 18.20. We go over to platinum. Again, platinum's incipient rally. As I've said before, it is the precious metal that seems to be the ugliest horse in the glue factory. Fairly unloved, very light positioning on the US futures market, so the participation rate isn't great. Couple of things to look at here. This trend line support that we'd seen sort of semi-holding over the course of the last week. We can see a close below and above and on just above it. I guess everybody got excited when we managed to break higher, go through 946, break the 100 and 200 day moving averages and close just above them. Only to give all that back and then some yesterday. A bit of a tragic circumstance, really, but there's no doubt about it that this trend line, this upward trend line, has well and truly been broken. Although obviously the participation rate isn't high, holiday thinned markets this week. This is a fairly negative looking chart, frankly. Now resistance today, for instance, will be back at this trend line at around 936.50. Beyond that, again, we have the 100 day moving average, the sort of 946 area, and then the 200 day moving average up and around 949. So a lot of wood to chop. And actually, when you look at this chart, you can actually say that platinum actually tried to test its 100 and 200 day moving averages and failed. So to get excited about platinum again now, we will definitely need to see a couple of daily closes above the blue line. Underneath 920, yesterday's low, and then this must hold levels of 904 and 890. So 890, if it goes, if we squash this chart up a bit, definitely implies, as you can see by all this clear air here, that we are about to have some fairly vigorous downward momentum. Palladium, the metal everyone seems to love this year. Again, looks like from this chart may have started running out of steam a little bit. I've blown the chart up here so we can see just how far back the long-term trend line support runs. But in the sort of shorter to medium term, this trend line here, as I drag it back into screen, has definitely broken now. And we've definitely had a number of daily closes, like basically a whole week's worth of daily closes below it. We've also attempted to break back above it, which is a classical technical formation, and this may imply that we are in for a bit of a correction on Palladium after it hit these heady heights of 1,027 the previous week. Resistance now, apart from 1,027, will be the trend line itself, and that's up at around 1,007. Downstairs, 975.70, which is these sort of roughly these two daily lows. But to put things in context, we do have a massive amount of support on the downside from a longer term point of view. Firstly, we have the 100 day moving average at 930. Then we have the series of daily lows at 906.80. Then we have that long term trend line support, which is around this 877.90, let's call it 878 level, and then the 200 day moving average, which is around 868. So long term, the trend is still intact from a technical perspective. In the shorter term, it looks like we may be getting set for a long overdue correction in the Palladium bull run. Looking at copper, again an interesting formation here. I've drawn this lovely descending triangle on it. It does look like copper has just run out of steam as well. For now, there is talk that industrial production will fall or slow down in China over the winter as the authorities there shut down or reduce production in a lot of these big polluting factories to reduce the degradation of the air quality in a lot of parts of urban China over the winter. This has led to an increase in ore stocks in ports and in offloading points in China, iron ore, coal, copper ore, as we head into the winter. So we do seem to be getting set for a bit of a correction. This top of the triangle is held beautifully. 1, 2, 3, 4, 5, 6 points. We have a triple bottom here at 302.40, 302. Let's call that one 302.30. Let's call it that. The top of the triangle to the bottom of the triangle is about 20 cents. So if we take 302, a break through this level now, a couple of daily closes would set us up for a correction down towards the 282 level. We do have a bit of wood to chop first. These multiple daily highs, 297, which is also joined by the 100-day moving average at the same level. A less marginal line here at 290.60, followed by another series of daily lows around 284, which is actually pretty close to what our target is. So all in all, copper is exhibiting the signs that it is getting set for a bit of a correction in its very impressive run higher since May. Starting to go to energy now. Natural gas, not much to really say about this. We are trading to the top side of the recent longer term trading range as we approach the autumn and winter months, and particularly North America, where gas demand typically moves higher for heating and power generation, etc., etc. Interestingly, the pullbacks have all been held in recent times over the last couple of weeks by this 200-day moving average, which is at 298.26. So this is definitely a pivot point, and I think a daily close below this level would imply that we could probably move the distance from this sort of 298 to 315 high. We could drop almost down to about sort of the 285 by the equivalent of that, down to that. It does seem to be a pivot level. If we look back into October, we can see it held it multiple times, and then when it finally broke, it actually exploded to the top side, to the top of its recent range. Overall, natural gas is still stuck in a 297.5, 315 range, but definitely looks like it wants to trade to the top side of that range for now. But do keep an eye on the blue line, the 200-day moving average. Brent crude. We have the OPEC meeting and non-OPEC meeting in Vienna on the 30th of November. As liquidity reduces into Thanksgiving week, we are starting to see a lot of choppy ranges in oil, as a lack of news, so to speak, and speculation about the OPEC meeting seems to be translating into some intraday volatility. We can see finally this topping formation led to that final meaningful correction down in Brent last week. Long overdue, given the overbought nature of the RSIs. They usually do win. That's actually completely unwound now, and we're sitting nicely neutral on the RSI. Nothing to see here right now. We have had some quite impressive sort of $2 range days, but when the dust has settled, it really does seem to be following the nuances of the US dollar. But there are also some rumours that Russia may not sign on for an extension of that production cut deal to the end of 2018, but this is more rumour than fact at the moment, and it could be a bit of a negotiating ploy. So I think for now we are in for some choppy range trading days as liquidity falls away, and a lack of news, particularly this week, doesn't really give us much to hang our hats on. We do have quite a lot of support though on the downside in Brent. So initially 61.25, then we have 61 sort of 15, and if we just extend this trend line out, now that trend line comes in around just above that at about what we got here, about 60.25, which is around the 60.15 level. So we could probably say that 60.00 is a pretty key level psychologically and technically support-wise for Brent, and that we really would need to see a break and a close through that to see an extension. Beyond that, though, we still do have the long-term uptrend line that goes all the way back to June. That's around the 57.70 level today. So Brent is still technically in an uptrend all the way down to 57.70. So there is actually plenty of room for Brent to correct lower and still remain in its uptrend. On the top side, we have a double top. We have a double top at 64.50, one at 64.85, and this is fairly formidable resistance in the near term. WTI. perhaps looking a little more vulnerable, to be honest. It doesn't have the layered support underneath it that Brent does, but then it doesn't have a backwardated futures curve either to support it. Resistance definitely this previous week's high, 57.80. Then the rally back to 56.75. We are slowly contracting in ranges here. The key level here now is this trend line support that goes back to the beginning of October, and that sits today at around 55.50. That would open up a test of 54.70, which I haven't drawn on to keep the chart less headachy. And a breakthrough there would actually imply that we are going to have a bit more of a meaningful correction, possibly down into the 53 area. Straight into the softs today. And it's been a pretty quiet week on the softs. I think the main theme here is there's been some short squeezing action. There we go, just trying to get the 200-day moving average in. We've seen a short squeeze after those Brazilian rainfall reports of last week, and that short squeeze is carried through into the start of this week. But I think as we saw position squaring ahead of the latter half of the week where everybody's going to be pretty much away on vacation, we saw some position squaring in a low liquidity market. Let's see if we can blow that up a bit more. And we saw pretty much sugar giving back all its gains from the previous 5 days trading, which will disappoint bulls, I know. But I guess the takeaway from this is we are still holding above the 100-day moving average at 13.88 today. Resistance is still pretty solid here at 15. This double top here, yeah, it's you have to respect that. And then we have the 200-day moving average behind that at 15.24. So there is wood to chop up here actually, but I guess if you're looking for higher prices and sugar, one thing to say is at least it is trading towards the top of its range. I will note that the RSI almost went into severely overbought territory, and those of you who follow this presentations will know that I'm a huge respecter of RSIs, so particularly on the commodities and precious metals. So it's definitely something to keep an eye on. Very hard to get bullish on sugar when it's such a low momentum rally when the RSI goes overbought. Let's look at the soybeans. The busiest chart out of the softs this week. We can see originally this triangle I drew and the breakout, and then the pullback came down to this beautiful bottom of the triangle here, this retracement line, and you can see how well that held all those retracements. That came to a bit of an end over the last week. We finally broke through it, and of course we extended. We broke through the 200 and the 100-day moving averages. We have attempted to rally again, but more significantly about that is that the short squeeze when it happened in soybeans stopped at the previous uptrend line. So this becomes resistance now, and you can see here we've pretty much failed there 2 times over the last 3 days. This is a pretty bad sign for soybeans, to be honest. Resistance today is at 9.8350, and we really need to see the beans have a decent daily close above that, preferably 2, in order to say that we can retest this 10 area, which is pretty key resistance now, although I haven't drawn the horizontal line on it. Otherwise, we're sort of looking towards these 100 and 200-day moving averages. This 973 will be intraday support. And then if we were to break through this sort of low down here at around 9.56, that would almost certainly be a signal that we are going to extend those losses. Bear in mind, it's not just this low around 976. We have another low very close to 976. So this is almost a daily double bottom. Actually, let's put the horizontal line on it just to highlight it. So a breakdown through here would imply that we are going to extend almost certainly down to the 9.3 level from a technical perspective. Corn. Not much to say here. Again, it sure saw a short squeeze, much like the other softs. That came to a bit of a halt last night, but it's actually held up better. I'm just trying to get this 200-day to draw in. Better than expected. But actually, at the end of the day, we are sitting mid-range on its long-term range trade, which goes all the way back now to the start of September. So we're talking 1, 2, 2.5, nearly 3 months now. So this 3-month range is still holding very, very nicely indeed. You can make money doing trades in the range trade. You'd obviously be looking to sell towards the top and buy towards the bottom, and then you need to have a bit of patience. But as far as trending markets go, or trend followers go, corn is not very exciting, I'm afraid. And in the absence of any other drivers in the general commodity set, agriculturals this week, I'm afraid this is what it's probably going to look like for the rest of the week and into the early part of next week. Let's finish with wheat. Wheat really hasn't felt any love at all over the last week. Been sideways trading, and I would expect that is how it's going to look for the rest of this holiday thinned week as well. Wheat itself seems to be running into a topside ceiling due to very high Russian exports globally. It's also priced in rubles, so it's much cheaper than paying for US wheat in US dollars, and they do seem to be grabbing international market share. That seems to have put a sort of a structural top in wheat for now. But actually, when we take when we look at this chart, we can still see that despite the noise, we are still stuck in this 393, 439 longer term trading range going all the way back to August. And actually, when we look at the closes, the right-hand bars on all these bar charts, the notches, we can see actually the volatility is very, very low. We've been closing pretty much not too far from where we started the day before. So wheat itself looks solidly locked in a fairly narrow trading range within its greater trading range. And we're going to have to see again some sort of external input here event-wise in order to break that out, I think, over the next week or so for sure. So that's a little bit shorter than usual, but hopefully you found this useful. I would like to thank you for listening in, and I wish you all a wonderful Thanksgiving if you're in the United States. And for the rest of you, I wish you a happy and profitable week of trading. Thanks very much, and goodbye.